We've been fielding questions from clients regarding banks right now, and there's a lot of headlines surrounding the banking industry. Doug, can you walk us through what we're hearing in the headlines and what has been led up to this point?
Yeah, so Eric, last week started with a conversation about a bank out in California called Silicon Valley Bank. And there were concerns over its viability. Regulators came out and said that they were totally within regulations. And by the end of the week, the FDIC and the state of California had taken the bank over. Essentially, the bank had become insolvent, and that had then brought additional concerns with other banks throughout the country. In a nutshell, what has happened is that the bank had a duration problem. And what a duration problem is that when we as depositors put money in a bank, we are demand creditors, we're demand deposits. So we can go take our money out whenever we choose. Whereas a bank takes the deposits we put into the bank and they put them to work. It might be lending on autos, it might be lending on homes, it could be purchasing treasuries or other types of bonds. And all of those have some term or duration until they're liquid. If they loan money to someone to buy an automobile and it's a 7-year loan, which is the most typical loan today, if I put $100,000 in the bank and it's used to purchase a car used to fund a car loan, but then tomorrow I go back and I want to pull my $100,000 out, the bank can't turn it to cash. Now banks operate that way. They pay us a return on our deposit, and then they lend it out at a higher rate over time. The problem is that if everybody comes to get their money out of the bank, then the bank can't turn it to cash and cover those deposits, those withdrawal requests. And that's what's happened. There was a run on the bank last week. $42 billion was removed from the bank or withdrawn from the bank in a very short period of time. That was about a quarter of the bank's assets, which created concerns. Social media got involved, and it spread like a wildfire, and concerns continued to grow to the point where the bank just had no way to cover it.
Understood. Yeah, so immediately we think of, and the questions we get from clients are, hey, does this remind you of 2008? Are there any parallels you see or differences in this current circumstance?
Yeah, that's a great question because I've been through a few of these in 40 years. So 2008 was different. 2008 was primarily a credit quality issue where banks held paper that was rated AAA when it was actually junk. The term of the day was tranches back then. There certainly was a little bit of duration risk, but most of the problems in 2008 were lending on assets that were worth substantially less than the loans that were outstanding. If you'll recall, mortgages were issued up to 100% of the value of a home. At times, you didn't even have to pay principal, and in some cases, there were Alt-A mortgages where you didn't even have to pay all the interest. They just added it to your loan, which left banks in a position where the loan was greater than the value of the asset. That is a little bit true today, but it's more of a duration issue. So I mentioned duration in the last in my last comments, and what I mean by that again is that when you have a demand deposit that goes into an asset in either let's say they buy a 10-year treasury bond, they get paid interest, and normally they pay me some amount. Let's go back 2 years ago. The bank was paying 0.1% and buying treasuries at 1.5%. So they were making the spread on that. Now interest rates, the Fed has been raising interest rates, right?
Yeah.
And a treasury, a short-term treasury is paying 5%. So I want to go out and I want to take my money out of the bank that's paying 0.25% and go buy a 90-day treasury bill that's yielding almost 5%. Well, the bank needs to come up with the cash to give me my money back, but they have a 10-year bond that was paying 1.5%. They can't liquidate it, and because interest rates have risen, the value of that bond has dropped by about 15%. So if they bought a $100,000 bond, it's now worth $85 if they sell it. If they hold it for 10 years, they'll get the $100,000 back, okay? But if they need to get it out now to pay me back, they're going to take a hit. And so what has happened is the Federal Reserve has created the Bank Term Funding Program, and now what they're doing is, and this was just came out over the weekend, they're going to basically allow a bank to deposit that asset with the Federal Reserve, and they will give them the full amount of the value of it. So if it's a $100,000 bond, the Fed will give them $100,000, even though today's market value might only be 85, right? But that will allow time for the values to normalize.
Okay.
And so that's what's going on now. More of it, not that there aren't some lending issues and some credit quality issues and some particular issues around, for instance, Silicon Valley Bank. But the biggest issue right now is a duration one. And that's why you see potential contagion. That's what the Fed's interested in stopping. They don't want this to extend to all regional banks who live and breathe lending. They make their money on a spread, pay the depositor this, lend it out at a higher rate. They keep the difference between the two. But all regional banks have this dynamic where interest rates have risen. The assets that they've loaned out are worth less today than they were when they lent it. They will get paid the full principal. It'll just take time. And so that's where the contagion has been kind of going, or the concern over contagion has emerged over the last couple of days.
Okay. So I think one of the other questions we get and immediate concerns for how it impacts households is, are my deposits safe? Is this money market going to be safe? Can you explain to us just what a deposit, what a money market is, and understand the mechanics behind it?
Sure. So first of all, the FDIC insures a bank deposit. And the FDIC insures $250,000, without going into a lot of detail, basically per registration. So if you have $250,000 in a bank, it's insured all the way up to that $250,000. If you have a joint account, it's insured up to $500,000. So theoretically, you could have a husband and wife each with $250,000 in an account, and a joint account at $500,000, you would have $1 million of coverage. So if you've got money in the bank, there is protection, and the FDIC came out as a result of what's going on at Silicon Valley Bank, Signature Bank, First Republic Bank, and I think all three of those will ultimately be closed. And they're now assuring depositors that they will get full access to all of their money. That will be paid for by an insurance premium they collect from all banks. All banks will have to kick in to pick up any cost of that if you're doing business in the banks. The second question you asked about, what about my money market? So money market is a generic term. There are really two types of money markets. One is a money market account at a bank. And a money market account is a deposit account, just like the ones we talked about, that you might get a little bit higher rate of interest inside of the bank. But it still is a bank deposit account where those funds go to the bank and the bank does something with them in their own portfolio, and then they pay interest. It might be higher than what they give on passbook savings. It might be higher than what you get in your checking account, most certainly. We all get solicited stuff in the mail. There's a premium money market rate for 6 months. That's really more of a marketing element. And those are, again, subject to the same issues with the bank and the bank's ability to repay your deposit. Then there's a money market fund, and that is a totally separate animal. A money market fund is a fund where you own shares, and they typically have very short duration, high quality paper or bonds behind it. Typically, I'll use an example, Fidelity Government Cash Reserves. It's got a 7-day duration. What that means is that all the money is liquid essentially within 7 days. The vast majority of it is in government bonds, which are highly liquid and very safe. So a typical money market fund does not have the same claims of a bank depositor or a bank creditor. They are just owned by the shareholders, not by the institution itself like the bank.
Awesome. So covered a lot of information, also barely scratched the surface on how deep we could go into this situation. Is there any other advice you're giving to clients, anything that we're watching for that you'd like to just relate to the group?
Yeah, I think this situation just shows how the financial system works and the challenges within the financial system. The Fed is trying to control inflation, so they're raising interest rates to purposely slow the economy down. But that has ramifications, right? When a bank lent money 2 years ago at 1.5%, but depositors today want 5%, they can get in a treasury account. And perfect example, for the last 90 days or more, we've been contacting clients and saying, hey, your bank deposits are paying 0.25% or 0.5%. Maybe they've come up to 2%, but we can use managed treasuries over here and use short-term treasuries and earn 5%.
Right.
It makes a lot more sense for the client to say, hey, I've got a large amount of money sitting in an account here. I move it over, we put it in treasuries, and you earn 3% per year more. That puts stress on banks, right? Yeah. It's better for the client because they're earning more interest, but all of that money coming out of the banks is putting pressure on the banks because they're not planning for this kind of liquidity crunch. And to the extent that they raise their rates that they pay depositors on your savings account, that's making it more difficult for them to even make a profit on the money that they've got loaned out in their portfolio.
Okay. Well, thanks for walking us through that. Obviously, there's way more to cover, and obviously we can tie this to personal situations. We're having these conversations with clients over the last 90 days as rates have risen, what their opportunity is in their own accounts, and opportunities we see in the future, and also mitigating any risk we see out there. So thanks for walking us through some of the information, and please reach out with any additional questions.
Thank you.